Do you feel it? That quiet uneasiness when you check your investment portfolio? The nagging doubt as you watch market records being broken while your everyday expenses keep climbing? You're not imagining things. Your financial instincts are trying to warn you about something that's happened before and is unfolding again right now, like the distant rumble of thunder before a devastating storm. I've spent decades studying market cycles, and what I'm seeing today is unprecedented. The pattern that preceded both the 1929 crash and the 2008 financial crisis has returned, but this time with alarming amplification. The signals are flashing red across every sector, yet financial media continues pushing the narrative that everything is fine. While your friends and colleagues chase the latest market highs, history is about to reward the vigilant. In the next few minutes, I'll reveal a converging pattern so clear that once you see it, you'll understand why the coming crash will make previous collapses look minor by comparison. And more importantly, why there's still a narrow window to protect what you've built before the majority realizes what's happening. Let me take you back to 1929. America was experiencing what appeared to be unprecedented prosperity. The Roaring Twenties saw the Dow Jones Industrial Average increase tenfold, from 63 points in August 1921 to 381 in September 1929. New financial instruments allowed ordinary Americans to invest with minimal money down, sometimes as little as 10% margin requirements. Companies trading at 50 times earnings became commonplace, with RCA reaching 73 times earnings despite generating modest profits. Banking reserves dwindled to dangerous levels as speculation ran rampant, with broker loans increasing 300% in just 5 years. In September 1929, economist Roger Babson warned of an impending crash, stating sooner or later a crash is coming which will take the leading stocks and cause a decline of 60 to 80 points. He was ridiculed by the financial establishment, with the Wall Street Journal calling him a perpetual bear, and Irving Fisher, the leading economist of the era, declaring that stock prices have reached what looks like a permanently high plateau. Just 1 month later, the market collapsed, wiping out 86% of market value over the following 3 years and causing the deepest economic depression in modern history. What fascinates me most about 1929 isn't the crash itself, but the systematic denial that preceded it. The Federal Reserve, major banks, and government officials all insisted the economy was fundamentally sound even as the structure was crumbling beneath them. The warning signs were dismissed as the pessimistic view of a few contrarians who simply didn't understand the new economy. Sound familiar? I need to pause here for a moment, because I can almost feel what you're thinking right now. That sinking feeling in your stomach as you recognize these patterns in today's economy. That voice in the back of your mind asking if your retirement will still exist in 2 years. You're not alone in this. I hear from viewers every day who say they've felt this same unease, but couldn't quite put their finger on why. Let me ask you directly, which warning sign I've mentioned so far resonates most with your personal experience? Your insight helps others in our community recognize these signals in their own lives. Drop a comment with the warning sign that concerns me most is. And share your perspective. Your comment might be exactly what someone else needs to read to finally take action before it's too late. Now let's examine 2008, a crisis I personally anticipated and profited from by identifying the fundamental flaws in the mortgage market years before others acknowledged the problem. By 2006, housing prices had increased by 124% since 1997, with some markets like Las Vegas and Miami seeing gains of over 180%. Ordinary homes that once cost $200,000 were selling for over $500,000 despite no meaningful increase in household incomes. Subprime mortgages were packaged into seemingly safe securities, blessed with AAA ratings from agencies that were paid by the very institutions creating these toxic assets. Leverage throughout the financial system reached historic extremes, with major investment banks operating with 30-to-1 leverage ratios, meaning a mere 3.3% decline in asset values would render them insolvent. When I began warning about the impending collapse in 2005 and 2006, I was met with the same dismissive attitude that contrarians faced before the 1929 crash. Housing prices never go down nationally, they said. The risk is diversified, they insisted. Ben Bernanke, then chairman of the Federal Reserve, stated in 2007 that the impact on the broader economy and financial markets of the problems in the subprime market seems likely to be contained. We all know what happened next. The financial system nearly collapsed, requiring unprecedented government intervention totaling over $29 trillion in loans, asset purchases, and guarantees. The market dropped 54% from its peak, wiping out $11 trillion in household wealth and forcing 10 million American families from their homes. Lives were shattered, retirement plans obliterated, and an entire generation's financial trajectory permanently altered. But there's another crucial historical example that receives less attention. In Japan during the late 1980s, we witnessed perhaps the most extreme asset bubble in modern history. At its peak, the grounds of the Imperial Palace in Tokyo were theoretically worth more than all the real estate in California. The Nikkei stock index reached nearly 39,000 in December 1989. The price-to-earnings ratio of the Japanese market exceeded 60, more than triple today's S&P 500. When their bubble burst, the Nikkei lost over 80% of its value and still hasn't recovered those highs more than 35 years later. Japanese real estate values fell for 14 consecutive years, with urban land prices declining 87% from their peak. An entire generation of Japanese citizens saw their wealth evaporate, never to return in their lifetimes. What makes this example particularly relevant is how Japan's central bank responded with near-zero interest rates and massive asset purchases, the exact playbook the Federal Reserve and other central banks have followed since 2008, but on a vastly larger scale today. The Bank of Japan now owns more than 50% of Japanese government bonds and has become a top 10 shareholder in over 50% of publicly traded Japanese companies, yet economic growth has remained anemic for decades. They created the blueprint for our current predicament, and we've followed it with disturbing precision. When we analyze these historical crashes, a clear pattern emerges that I've identified through years of research. Every major financial collapse follows a predictable sequence of 7 stages, as reliable as the changing seasons but far more devastating. First comes the credit expansion phase, when central banks keep interest rates artificially low and expand the money supply, growing at more than twice the rate of economic output. This creates the illusion of prosperity while actually laying the groundwork for inevitable collapse. Second is the asset bubble formation, when easy money flows into specific asset classes, driving prices to unsustainable levels disconnected from underlying economic reality, typically exceeding 3 standard deviations from long-term trend. Third is the euphoria stage, characterized by widespread public participation and dismissal of traditional valuation metrics, with statements like "this time is different" becoming commonplace and skeptics being ridiculed or marginalized. Fourth is the insider selling phase, when institutional investors and corporate insiders quietly reduce their exposure while publicly maintaining optimism, typically reducing holdings by 30 to 40% over 6 to 12 months. Fifth comes the initial distribution breakdown, when cracks begin appearing in the narrative and volatility increases, with 90-day market volatility typically doubling from its complacent base. Sixth is the panic stage, when the collective realization sets in and everyone rushes for the exit simultaneously, leading to daily price movements of 5 to 10% becoming common. And finally, the contagion phase occurs when problems in one sector spread throughout the broader economy, typically beginning with financial institutions and extending to retail, manufacturing, and services within 3 to 6 months. This pattern has repeated with remarkable consistency throughout financial history, and understanding where we are in this sequence is crucial to protecting your wealth. If you're finding value in this analysis so far, take a quick second to hit that subscribe button. We're just getting to the most important part, and I want to make sure you receive our future updates as this pattern continues to unfold. The information I'm about to share could be the difference between preserving your financial future and watching it disappear. Now let's apply this framework to our current situation. Since 2008, we've experienced the most prolonged and extreme credit expansion in financial history. Global debt has increased by over $100 trillion, reaching an unprecedented $307 trillion by mid-2025. To put that in perspective, that's nearly $40,000 of debt for every man, woman, and child on the planet. Central banks have purchased trillions in assets through quantitative easing programs, with the Federal Reserve's balance sheet expanding from $800 billion pre-2008 to over $8.5 trillion today, a staggering 10-fold increase. Interest rates were kept at historic lows for over a decade, with 25% of global bonds trading at negative yields as recently as 2021, a financial absurdity never before seen in 5,000 years of recorded human history. This first stage was implemented with unprecedented scale and duration. The second stage, bubble formation, has manifested across multiple asset classes simultaneously. We've seen real estate reach new extremes, with median home prices to median income ratios exceeding 8.6 nationally, compared to 7.2 at the 2006 peak. The average American worker now needs to work nearly 9 years just to earn the median home price, assuming they saved every single dollar. The stock market has been driven by the narrowest leadership in history, with just 7 technology companies accounting for over 65% of S&P 500 gains in 2024. Corporate debt has reached record levels while quality has deteriorated, with BBB-rated bonds, one step above junk, now constituting over 50% of the investment-grade market, totaling $4.8 trillion of potential fallen angels in a downturn. These companies are walking on a financial tightrope with no safety net below. The euphoria stage has been evident in everything from meme stocks to cryptocurrencies to AI speculation. New metrics have been created to justify valuations that make no sense under traditional analysis. Price to eyeballs and growth at any cost have replaced earnings and cash flow as valuation methods. We've witnessed companies with no profits and minimal revenues achieving multi-billion-dollar valuations, with the average IPO in 2024 having a price-to-sales ratio of 23, compared to 17 during the 2000 dot-com bubble peak. The insider selling phase is now well underway. Corporate executives sold over $63 billion of their own company stock in 2024, one of the highest amounts on record and 47% higher than the 5-year average. The very people running these companies are quietly cashing out while telling shareholders the future has never been brighter. Share buybacks have simultaneously decreased by 28% year over year. Major investment banks have been quietly reducing exposure to equities while their research departments maintain buy ratings, with Goldman Sachs reducing proprietary equity positions by 41% since January while publicly maintaining a 5,200 year-end S&P 500 target. The same pattern occurred before both the 2000 and 2008 crashes. The smart money is already heading for the exits, leaving retail investors holding the bag. Most concerning is that we're now seeing clear evidence of the 5th stage, initial distribution breakdown. Market breadth has deteriorated significantly, with fewer stocks participating in each new high. The advanced decline line has diverged from major indices since March 2025, with only 32% of S&P 500 components trading above their 200-day moving average despite the index making new highs. The yield curve has been sending warning signals not seen since the months preceding the 2008 crisis, with the 2-year per 10-year spread inverting to levels last seen in 1981. Commercial real estate vacancy rates in major cities have reached levels not seen since the early 1990s recession, with office vacancy rates in New York, San Francisco, and Chicago exceeding 27%, 31%, and 35% respectively. Walking through downtown business districts feels increasingly like touring ghost towns. Regional banks have reported alarming increases in loan delinquencies, with the FDIC's problem bank list growing from 43 to 183 institutions in the past 18 months. Credit card defaults have surpassed pre-pandemic levels despite supposedly strong employment, with 30-day delinquency rates reaching 8.7%, the highest since 2010. Auto loan delinquencies have reached the highest level since 2008, with 7.3% of subprime auto loans over 60 days past due. These are the cracks in the foundation that typically appear 6 to 18 months before a major crash. They're telling us something that headlines and financial media are desperately trying to ignore. What makes the coming 2025 to 2026 crash potentially worse than both 1929 and 2008 combined is the unprecedented convergence of 5 factors never before seen simultaneously. First, global debt-to-GDP ratios have reached 350%, meaning there's no capacity for further borrowing to stimulate recovery, compared to 280% before the 2008 crisis and 160% before 1929. We've essentially maxed out the global credit card with no way to make the minimum payment. Second, interest rates started from the lowest base in history, leaving central banks with limited conventional tools, with real rates still negative across 40% of developed economies. The monetary policy toolbox is nearly empty. Third, wealth concentration has created extreme market fragility, with the top 1% owning nearly 50% of all financial assets, compared to 28% in 1929 and 35% in 2007. This concentration means that when the wealthy decide to exit positions, markets will collapse with unprecedented speed. Fourth, demographic trends across developed economies mean fewer workers supporting more retirees, creating structural pressure on both consumption and pension systems, with the dependency ratio in the U.S. increasing from 3.4 workers per retiree in 2000 to just 2.1 today. We're witnessing the largest retirement wave in history precisely when we can least afford it. Fifth, and perhaps most importantly, the dollar's role as the world's reserve currency is being actively challenged for the first time since the Bretton Woods Agreement in 1944, with central bank dollar reserves falling from 73% in 2001 to 58% today, while alternative settlement systems handle over 43% of international transactions outside SWIFT. The foundation of America's global financial dominance is eroding beneath our feet. The timeline for the remaining stages is accelerating. The panic stage will likely begin between February and August of 2025, triggered by one of several potential catalysts: a major commercial real estate bankruptcy involving over $30 billion in defaulted loans, a sovereign debt crisis in an over-leveraged emerging market with at least $120 billion in dollar-denominated debt, or the failure of a systemically important financial institution that has overexposed itself to private credit markets, with leverage ratios exceeding 20-to-1 on illiquid assets. The contagion will spread faster than in previous crises due to the interconnectedness of global financial markets and the concentration of risk in passive investment vehicles, which now account for over 53% of all equity assets. When everyone heads for the exit at once, they'll discover that the door is far smaller than they imagined. By mid-2026, I expect major stock indices to decline by 65 to 75% from their peaks, wiping out approximately $38 trillion in global equity value. Real estate will fall 40 to 50% nationally, with certain overvalued markets experiencing declines of up to 65%. Unemployment will exceed 15% as the services sector contracts alongside manufacturing, with potentially 12 million jobs lost in the first year of the downturn. The social and political consequences will be as severe as the economic impact, with potential for unrest that makes recent episodes look minor by comparison. The warning signs are already flashing for those willing to see them. Housing affordability is at its worst level in recorded history, with the average American needing to spend 43% of their income to afford a median-priced home, compared to 34% at the 2006 peak. The personal savings rate has dropped to just 3.6%, leaving households with minimal buffers to weather economic turbulence, compared to 7.2% before the 2008 crisis. Most Americans couldn't handle a $1,000 emergency without going into debt. Corporate profit margins have begun contracting after reaching historic highs, falling from 12.7% to 10.8% in just 2 quarters. Labor force participation remains below pre-pandemic levels despite supposed full employment, with 5.8 million prime-age workers missing from the workforce. The velocity of money has collapsed to historic lows of 1.1, indicating severe problems in the real economy despite surface-level prosperity, compared to 1.8 before 2008 and 2.2 before 2000. Each of these indicators reached similar extreme levels in the months preceding previous crashes. The symphony of warning signals is deafening for those who understand the music. What can you do to protect yourself? The strategies that worked in previous crashes provide a roadmap, but the window for implementation is rapidly closing. Reducing exposure to equities, particularly growth stocks with high valuations and companies with weak balance sheets carrying excessive debt, is essential. Consider that during previous crashes, companies with debt-to-EBITDA ratios above 4 experienced stock declines averaging 83%, compared to 47% for those with ratios below 1. The difference between losing half your investment and losing nearly all of it. Shortening the duration of any fixed-income investments will help mitigate the impact of rising real rates, as bonds with 10-plus year durations typically lose 12 to 15% of value for each 1% rise in rates. Physical assets with intrinsic value and limited supply tend to preserve wealth during currency devaluations that typically follow financial crises, maintaining at least 80% of their pre-crisis purchasing power. Most importantly, maintaining substantial cash reserves despite inflation concerns will provide both protection and opportunity as asset prices reset to reflect economic reality, with previous crashes offering 65 to 80% discounts on quality assets for those with available capital. When others are forced to sell at any price, those with liquidity will be in a position of unprecedented advantage. The warning signs I've shared today aren't meant to paralyze you with fear, but to empower you with knowledge. Every week on this channel, I break down another critical economic pattern and provide specific actions you can take to protect yourself and your family. If you're the type of person who values preparation over panic, subscribe now. While others will be caught off guard by what's coming, our subscribers are quietly taking measured steps to secure their financial future. Join our growing community of financially resilient viewers by hitting subscribe and tapping the notification bell. Your future self will thank you for the small action you take today. In times of financial upheaval, information isn't just power, it's financial survival. And the time to act is running out.